Welcome to another episode of The Young Guns. Today, Luke and I want to explain the 3 things that we're looking for when we're picking a stock.
What are you looking for, Joe?
Well, in my opinion, I'm more of a fundamental guy, and Luke's more of a technical guy, which we'll get into. So the first thing I'm looking at is a company's fundamentals. So what do their books look like? What do their earnings look like? There's 3 things within that category that we really pay attention to. One, we want to make sure it's good value. Some stocks like Tesla look great, but at this valuation, I'm not sure.
They just started making a profit this year, really.
Right. So I want to stay away from that. We've seen a big pullback. The other thing we're looking for is a good growth story. So in this day and age, if you're not innovating, if you're not staying with the times, you're not going to keep up. And lastly, we're looking for a good management team. Kodak, they just got that huge deal, and look, it's already falling through. So we had a stock that went from $2, shot up to $50, and now it's back down to $5.
Right.
It's just that management team has never done well.
You want somebody that's there that you can trust to deliver on the expectations. So when you have somebody say, hey, these are the numbers we're going to put up, you're going to have somebody in management that's going to deliver those, because there's so many CEOs and executives out there that promise stuff and they never deliver. So, that's something you have to keep in mind when you're picking a stock, especially on fundamentals.
Yeah, think about Kodak. Did they ever keep up with the times?
No.
Did their cameras ever innovate?
They're always the old cameras, and then they turn into pharmaceuticals now. And then I think they were doing something else before this. Like they were always behind the times.
Yeah, and I don't think you can expect a management team that couldn't even keep up with cameras to keep up with the underlying drugs that are going into our pharmaceuticals. I just don't see it happening. So moving over to the technical side, what are you looking for?
So technicals, and I want to keep this very high level because technicals can get very complicated, and we've talked about this before in one of our podcasts about exactly what technicals are, but I'm looking at where previously the stock was. So when you look at a historical chart or you look at historical prices, you can kind of see where people are looking to buy the stock or looking to sell the stock. So where there's demand and where there's supply. So typically in these stocks, you're looking at bounces at certain levels. You're looking where it's going to sell off at certain levels, so you can sell the stock before it sells off. So when it comes down to this, there should always be something really you're looking at when you're deciding to buy a stock. Like Joe said, there's a lot of fundamental things you have to look for, but combining the fundamentals with technicals can leverage your portfolio and leverage your stocks to try to get the most out of it. The biggest issue we see right now, in general, not just right now, in the past, in investing in general, is people sell too early or they never cut their losses. So by having these certain levels in mind, you can allow stocks to run to these levels, or you can get out of positions where it might sell off and support doesn't really act as support. You set your stop loss, it kind of protects your position.
So looking at that support level, maybe go a little bit deeper. What are you looking for? Are you looking at a 200-day average?
Yeah, so typically moving averages are the most common, but one thing I will say is that a lot of technical analysis has been made more prominent over the past decade. So a lot of these levels everybody's looking for, and a lot of algorithms in the market are kind of priced at these levels. So technicals are always changing, and there's new things always coming about. So moving averages are the main thing that a lot of people use. Also, one of the key things to look out for is, like I said, previous levels that acted as either support or resistance. So we call those like double tops or double bottoms, where a stock might have bottomed 2 times in the past couple years, and it gets close to that again. You might want to pick up some of your position because it's likely to bounce again at that position. Same thing goes for if it sold off 2 times in the past there. Let's say a stock's trading at $100 and you look back in the history of the stock chart and it sold off twice at 110 over the past couple of years. You might look to loosen up some of your portfolio at 110 in that stock. So there's a lot of things that go into it, and there's thousands of different technical indicators, but it's really an interesting subject for you to study. It's really its own little math kind of subject. So right. It's really interesting. I enjoy that.
Yep. So moving into the second thing that I'm looking for is relative. We want it to be relative to what's going on in the time.
Yeah.
So there's a lot of companies that just for my age, I'm not looking at. Coca-Cola is a great company, but it's mature. Yeah. If you're looking for income, if you're looking for dividend paying stocks, then you may want to search and look for these stocks, right? But if you're in a position where you're a little bit younger, you're looking for that growth, you're just not going to see those big movements in those stocks. They're going to be more consistent. Think of a big wave coming. As those big waves coming, you got a big mature boat. They'll be fine. They'll sail through just fine. Yep. Where, that smaller boat, that growth stock may get eaten up a little bit,
Yeah.
but if you see the light at the end of the tunnel, if you see a catalyst of this can really change the world, this is the new technology that we all need, that is where you're going to see some serious growth if you're able to identify those companies early on.
And my number 2 is kind of similar to that, but on its own little different path. So I take a very top-down approach when it comes to investing. So I'm looking at all the stocks out there. I'm looking at all the different stocks. Then I'm taking a look at the sectors that they're in. Then I'm taking a look at the best stocks within those sectors. So when it comes down to relevancy and like how, these younger companies compare to these older companies, I'm taking a look at what sectors are going to be benefited over the next maybe 5 to 10 years with the current circumstances. Obviously, these circumstances have completely changed over the past 6-7 months because of the coronavirus, work from home, the digitization of basically everything. It's really important to understand what sectors are growing over the next 5 to 10 years. And there are different stocks within those sectors that are going to perform differently. But overall, if you can pick a winning sector, you're most likely going to do pretty well. I mean, if you take a look at like energy is not a really good sector and hasn't been for the past decade.
Right.
I mean, it was like a 15% weighting in the S&P. I think it's like 3% weighting now. So that shows you how much it sold off. ExxonMobil was trading at $90 a share. Everybody thought it was a safe stock paying a 5% dividend back. I remember 5-6 years ago. Actually, there was a teacher in my high school that his parents owned a ton of Exxon. He always talked about it every single day. It was looking at the stock every single day. And he's like, yeah, Exxon's like here to stay. And I'm like, well, it could be, but it might not be. And
that goes back to innovation, right?
Yeah.
You go back to innovation. If they can't keep up with the times, that's where you see the sell-off.
Yeah, exactly. So, I mean, it really comes down to picking the right sectors. And then if you pick the right sectors, you have a very good chance of at least maybe outperforming the market. And then picking the best stock in the sector is obviously the best thing you want to do. So, technology sector is obviously a very growing sector. And it will probably continue to be. So It's important to probably own best of breed within tech.
Yep. So going off my third, I'm going to piggyback off you. I look at a top-down approach too, but let's take it a step further. We have a global economy, but now with the coronavirus, it's not that global. There's a lot of onshoring.
Yeah.
We aren't seeing these big exports and import numbers that we were seeing before because borders are closed down.
Yeah.
And there's tension in China. There's some countries that don't want to work with each other. So at this point, I'm looking at, okay, where's the best place to be geographically? And a lot of people, there was saying that if you look into these different countries, these emerging countries, there's a lot of opportunity. But right now, I just don't see it.
Right.
So I'm sticking with the U.S. I think we're best of breed. We're USA. We're not going anywhere. We're going to do great.
Well, a lot of people like to do the contra investing, contra to what people, believe in. So like, for example, they like to buy stocks that are selling off a ton or that are very low compared to stocks that are at all-time highs. Mm-hmm. And it's proven that doing that is actually not good for you because there's a reason why stocks are hitting all-time lows. It's because they're not performing very well. I mean, It's not very hard to understand. The stocks that are hitting the all-time highs, they're delivering on their growth. They have the good management team that's there to put up the numbers. So, I mean, it's not necessarily bad to stick with the best of breed, like you were talking about, in everything, whether it be sectors, whether it be geographical locations, whether it be all kinds of political things that are happening all around the world, like you talked about. People don't want to work with each other. It's everything you need to keep in mind when you're picking a stock.
Right. So, kind of in conclusion, the three things we're looking at. One,
I haven't got to my third thing.
You haven't gotten to your third.
Oh, you skipped.
All right. I'm sorry. What's
Come
your
on,
third,
Joe.
Luke? What's your third?
So the third thing you want to look out for, and it sounds so simple, but it's actually very important. And a lot of people have missed out on opportunities because they did not do this. And all it is trusting your gut. It sounds so simple, but you shouldn't take these big bets that like people are nowadays on Robinhood, taking these big option trades and trusting their gut and gambling all their money away. But what I mean by that is take calculated bets in your head and trust your gut about which stock might pay off over the next 5 or 10 years. So taking a look at, which stocks are, the place to be over the next 10 years because it's in a growing sector, like maybe technology or maybe like artificial intelligence or biotech. There's all kinds of things. But trust your gut because honestly, let me tell you, there are many people who regret they thought something was going to happen. They regret not taking advantage of placing a trade and it ends up turning out to be a great trade. They would have made
Right.
a ton of money, especially if you're young. Take those risks, trust your gut, and it might net you a lot of money in the long run.
Absolutely. And I think the one caveat there is if you're taking a bet maybe on a biotech, those will really get you. You get to stage 3 and they fall through, they don't have the corona vaccine, you're going to see these things tumble. So if you're going to trust your gut, just don't trust that huge bet, right? Like you said, calculate it.
Don't take binary outcomes. Like for a lot of these biotech companies, you'll have there's a chance they're going to cure the vaccine and there's a chance they're not. That's a binary outcome. Either they do or they don't. If they don't, you're screwed. If they do, you're great.
Right.
And there's so many different companies working on it that you really have to own all of them to try to pay it off because most of them are going to fail.
Yep.
And one might pay off really good, but the other ones aren't.
Right.
So don't take binary bets, but trust your gut on other things other than binary bets and
Absolutely.
where you think the stock is heading. And you might have, some good reasoning behind it, but there might be one little reason saying, hey, in your head, like, you shouldn't own the stock. Maybe it makes sense if your gut's telling you to and your head's telling you not to, maybe you should just do it.
And you see that with everything in life. But
and you probably make some of your best decisions by just trusting your gut.
Yep.
If you look back at almost every decision that you've made in life and the ones where it didn't really make sense, but you just kind of trusted your gut, I bet you those paid off the most.
Absolutely. So in conclusion, my 3 are going to be fundamental analysis, relevancy, and taking that top-down approach. So looking at Luke's 3.
Technical analysis. 2 is kind of that top-down approach when it comes to sectors. And the 3rd is trusting your gut.
So
it'll pay off.
It will. So if you have any questions at all, if you have certain ways you're looking at stocks and you're picking them yourself, we would love to hear about it. Leave a comment below. But again, thank you for tuning in to another episode of The Young Guns.